Well, folks, Tom Lee of Fundstrat does it again. I swear, this guy is either one of the most intelligent investors of our time, or he's an absolute degenerate, and I suppose now that I'm thinking about it, in either case, I think that should be admired. For those of you who need a little bit of context, not long ago, about a month ago, the start of October, Tom Lee came out with some very bullish predictions. Tom Lee sees the S&P 500 topping 7,000 by year end and says, don't be fooled by the shutdown calamity talk. Well, since then, the market's been a little bit of a rocky ride, and some days where we have the bigger sell-offs, well, the internet loves to dunk on him. Breaking, Tom Lee has left the country. Tom Lee selling his ETH stack before fleeing the country. Tom Lee spotted in Los Angeles today. Obviously, this is with the overall market, Bitcoin, and especially Ethereum. Whenever there's a little bit of a rough patch, because he's so bullish, because he's so well known, well, the internet does internet things. And just to be fair and balanced, maybe we should look at the actual numbers here. The market's been up and up and up. He made this call in early-ish October. We went up, we got hit, we recovered, we got hit again, and probably will keep recovering. I have no idea. Bitcoin's a little bit more severe. In October, he looked really smart at first because it just kept going from there. Since then, we have lower highs and lower lows, but for all I know, maybe the bottom's in right here at 100,000, and that's where people decide to YOLO it. Obviously, it could also break down, but I just want to give you a little bit of context for the interview he just dropped after all of this chaos.
Joining us now, Tom Lee, Fundstrat Global Advisors, Head of Research, and a CNBC contributor. Once again, Tom, looking at your last couple of appearances, whenever you're, actually it's been a while now, when you're on, I kind of hold my breath after some of your forecasts, because a lot of times I think no way, and then it's always seemed you have not.
He is more right than he is
really
wrong thus far
in any significant way. Do you ever have any trepidation, second thoughts? Do you ever get nervous about any of your calls?
Yeah, all the time, filled with doubts, because the future. It's
no one can be right off your 51%. You're like the best ever in this business. You're still bullish, even though you talk about last week a little wobble in some stocks. Sell on the news because of China. Now, it looks like a little bit of hawkishness out of Jay Powell. I don't know if that lasts.
Yeah, that's right. I think the market has a lot of walls of worry because we've got the shutdown, we've got China, we got the Fed speak, but the market's been up 6 months in a row now. Only 6 times since 1928 that's happened.
Did you hear that? 6 months in a row, we are green. And that's only happened a handful of times in the past 100 years. I think that really is a good job at offering the context of how crazy the current market is.
If you look at November, we're up 5 or 6 times. And in 1942, it was flat. So basically, November should be really strong. I think at least 200 points on the S&P. So maybe...
For November.
Yeah, maybe even 250. So maybe we get to 71.
See, that's a call that I just wish you wouldn't make a call
says,
like
nah,
that, right?
honey, no more 7,000.
You could
250
to 3% if that makes you feel better.
It does make me feel a little bit better, because 250 points to say in November, 250 points. You're giving a time and a size.
Love it.
But maybe we wobble the first couple weeks just to digest all the gains.
Yeah, that's what I saw in your notes. So initially there could be some choppy trading.
Oh, to clarify what they're talking about, in his Fundstrat note that he puts out, and you can read it if you want, even though he's very bullish on November, he thinks that the market's going to take a little bit of time to digest the current news of what's going on with the government shutdown and the U.S.-China trade deal and the Supreme Court and all that. So he's looking for the first portion of November to be choppy and then a pop in the second half of November.
Well, what's driving everything? There's still, I guess, sentiment is not positive, is it? You mentioned the wall of worry.
Yeah, I mean, if you look at it like AAII, the average sentiment this year is still minus 11.5, like net solidly bearish. That's only happened 3 other times in 35 years, all in the middle of bear markets. So investors feel like it's a bear market, but we're up 17%, which kind of tells me I think there's a big performance chase into year end. Over 80% of fund managers are missing their benchmark this year.
Wow. And you don't care about not having government data, because does the market ever really wait for government data? Or it sort of sniffs it out, doesn't it?
Yeah.
The all-knowing market.
That's right, because we have good Fed futures to look at what's implied for inflation. The Fed looks at the bond market. The bond market figures things out before the data comes out. I do think the inflation is probably falling a lot faster than everyone expects. I mean, you can look at Trueflation, and we're down to sub 2% inflation, excluding housing.
Shelter, yeah.
Yeah, and shelter is finally cracked.
Yeah. Because that CPI number was, it was just barely cooler than expected, wasn't it?
Yes, but the shelter piece is now at 0.16 month over month. That's at 2% year over year. That level would bring core inflation down sharply. And over 54% of the CPI components are now deflating. It's the highest percentage since COVID started.
It seems, Tom, that the markets have, largely because of what you're describing, moved on from the inflation watch.
Yeah.
They've kind of put that aside as maybe the forefront risk, and much like the Fed has been dragged to doing, wondering about downside risk to growth. I mean, if you just look at things like the reaction of home builder stocks, consumer cyclicals, regional banks, just to that hawkish cut by Powell last week, it seems like it's not hard to get the market a little bit uneasy about, just exactly what kind of a soft patch this is, even if we have confidence that maybe it firms up into next year. So how does that play into the overall action in the index and what you expect from the market?
Yeah, I think there is something the market's trying to figure out, which is AI is consuming jobs, but that's turning it into profits for corporates. So like profits are expanding. And then we have profit margins have actually been going up in the middle of tariffs. So how are companies able to take 70% of the tariff hit, but margins are going up? So there must be a productivity boom somewhere. And then we have, like you said, $7 trillion of cash on the sidelines, but we have high rates. And so the Fed, I kind of think, is trying to not overheat the economy, but we know that you just point out, like, housing's in big trouble. So I would say it makes sense if inflation's in a good place and jobs aren't really strengthening for cuts to happen, and that would be really dovish. So I think that sort of comes together before the end of the year.
Andrew.
That's how we can see
7,100. Have you been reading all these stories that just been out, recently here about how the Fed is doing all of this sort of repo activity, like a lot of repo activity, and I just wonder what that really means for both the markets and maybe even for crypto. This is a ton of money. I mean, it looks like something like $30 billion.
Repo is the overnight lending market, and generally when the Fed has to step in, not so good. It means that there's liquidity issues, and this is all for big banks and literally how much money they're lending to each other overnight for whatever processes for really small interest rates. I myself have been seeing some of the news about why the Fed is stepping in right now. Generally not so good, so I'm actually curious myself what Tom has to say about it.
These liquidity concerns, this is, past couple of days kind of thing.
It is pretty typical into month end, right? That's what we are seeing. And I think that some of these numbers are also being distorted because of the government shutdown. So we know that the Treasury reserves are building because there aren't any payments being made. So it is something we're watching. But if I was to say that there's signs of bank stress, I'd also be looking for high yield spreads to be widening. And those are actually staying pretty calm.
So you figure no problem with 7,000 by the end of the year, more likely something even above that in your view? Like what, like 7,300?
Yeah, I mean, maybe 7,300, 7,500.
7,500.
Yeah, so we still, in December, we would build on those November gains.
See, Santoli's like, no way.
No, I don't say no way. I'm open-minded to how far bull markets can go, right? Strong years end strong. We all know about that. The one piece of it I think it's worth kind of struggling with a little bit, though, Tom, is you can look at the AAI surveys, kind of what people are saying, and then you see, equity exposures in, Bank of America private client accounts are basically at their highs, right? So people have kind of, in aggregate, been riding this to some degree. And then you see a lot of what we've talked about in the last several months of, this kind of upwelling of speculative action in non-profitable tech stocks, low-quality equities leading. That's not the Mag 7. That's like a lot of other marginal stuff. So how do you jibe that with that sense that people are still skeptical?
Yeah, I mean, one, we know there must be skepticism because if people were bullish, the institutional fund managers should have better performance. But as you know, this is one of the worst years for fund managers in almost 30 years. I think that there is also kind of problems in private markets. So I think private credit is doing terribly, and I think a lot of LPs in alternative funds, whether it's venture or private equity, are pretty disappointed by the returns, like the 5 years into now. but the stock market's done well. So I think that there is bearishness because like private equity hasn't come through and fund managers are doing badly. But you're right, the ones who stuck with public stocks are doing well.
I want you to quit while you're ahead, but I have to ask you about Bitcoin. I mean, you want to go out on a limb there too? Because
there's a going with Bitcoin.
Go below 100 or no?
Well, Bitcoin, I mean, if I look at everything since October 10th, because that was the biggest liquidation in the history of crypto, like bigger than FTX.
Like a margin call almost.
Yeah, it was like almost a miniature rupture, like a tsunami. We're only a couple weeks from that, so I think the market is consolidating. But if I look at fundamentals, like Ethereum, stablecoin volumes have been exploding, application revenues at all-time highs. So right now, fundamentals are leading price in crypto. So I think eventually we consolidate and then we rally into year end.
To be fair, ETH recently took a larger hit because of a hack. Bitcoin did go below 100K, but as I showed you, quickly bounced back up. So we'll see how it plays out. But Tom Lee, as bullish as ever, comes out at the start of October with very high targets, and then all of a sudden says, yeah, I get that I'm getting dunked on the internet, but I'm raising my targets. So with that being said, obviously time will tell, but I would love to get your thoughts in a comment below. Do you think he's right? Do you think he's wrong? Or do you think the answer is somewhere in the middle? Appreciate all the good vibes. Catch you in the next one. Peace.